My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today we got another special guest, Wayne Courreges. Awesome name. Zooming in from beautiful Texas. And Wayne is a very experienced real estate investor. He's the founder of CREI Partners.com. And he knows a thing or two about doing big deals. So Wayne, welcome to the show. Great to have you.
Thanks, Dave. Appreciate you having me on today.
So Wayne, give us a little snapshot about what you guys focus on when it comes to real estate investing. Kind of what's your buy box and what does the portfolio look like as of mid 2025?
Yeah, we're niched in on primarily multifamily. I say 80% of our investments is multifamily, 100 plus unit size, typically about 100 to 150 units, 1980 or newer. Really focused in on the Texas Triangle, and even within there, heavy on Houston, and we are expanding into San Antonio with just purchased one asset about a month ago, and we have another one that's closing over the next 30 days.
Congratulations.
Thank you, in San Antonio. And then the other 20% is more, I would say speculative, but different types of asset classes. We've done a 20 by 50 storage development. They're all 20 by 50 size units. We can definitely dive into that. It's definitely a great niche. And then we have a real estate development in Bryan, Texas, that will consist of 150 unit multifamily. It will consist of a hotel that we're working with Marriott on, and then a retail office component. So that's like the 20%, but our bread and butter is cash flowing multifamily assets. Very,
very cool. So what does a portfolio at the moment kind of consist of? How many different communities or properties do you have? What's kind of your unit count?
Yep. So in Houston, we have 3 multifamily communities. In San Antonio, we have 1. We're about to add on to that. So there'll be 2 in San Antonio. We have a build to rent community. This is under development, but just came back from Lafayette, Louisiana today. Actually, was there yesterday. Came back today. That is a 98 unit build to rent community. So for those that are not familiar with build to rent, think of it like a horizontal multifamily instead of your traditional sense of vertical apartment community. These are 98 homes that are treated and managed like a multifamily. And then in Huntsville, Alabama, we have another 20 by 50 storage facility and partners on a retail facility there. And then in Bryan, Texas, we have a 20 by 50 storage. And then I mentioned the development. So yeah. That's our portfolio as of today.
Excellent. Well, that is exciting. It's a little bit diversified. Don't have all the eggs in one basket. Speaking of which, a lot of people in the multifamily space over the last few years have been hurting mightily. How has the shakeout in multifamily affected you guys, if at all?
Yeah, so my background was with CBRE. So for 16 years, I was with a large commercial real estate company, CBRE. In 2019, I started CREI Partners. It wasn't until 2022 that we started buying assets. So it took a while because it was really a struggle to find properties that penciled. I said no to a lot of properties just because they weren't making sense. So we have one property that we had to do a loan modification on. I think anybody that's been in real estate investing over the last 10 years or so probably has one that's, they've worked on. But, fortunately for us, it hasn't really impacted the portfolio. We haven't lost any investor capital, et cetera. And that's just because we were really, and we still are very conservative on saying no to most properties and buying with fixed rate debt. Most recently, we've been very creative of what we buy. For example, we did last year, it was 128 units in Houston, a loan assumption of 3.82% fixed rate. Ooh, prior to that, nice. We did a seller fixed rate financing for 5 years interest only. The property we bought in San Antonio last month was purchased about $3 million less than it was last year, which is like mind blowing. But it's unfortunately, that seller had to do a massive sale because of what you're talking about, where a lot of sponsors during that time, loans went bad. So it's it's not that we're trying to be beneficiaries of people suffering. It's not the case. It's just, I would say, the timing and us just being really, we all wanted to do deals. I wanted to do deal time and time again, but it.
You're a patient.
I was patient, right?
Yeah.
But I wasn't completely out of the woods. I mentioned that one, and
Yeah.
I do talk about it openly because it is something that, like, hey man, like it's real estate is not easy, but it's like, what do you do to get through it, especially for your investors? You fight for it. Do you put your head under a pillow? Those are things that, matter. And so, fortunately for us, we were able to work through that and, get on the other side. So knock on wood, we'll just continue,
Wow, that's exciting. So perked my ears up when you're talking about the storage developments. And I think that's kind of one of your babies that you really kind of like. So tell me a little bit more about these units. First of all, they sound a lot bigger than normal storage units. So tell me a little bit about this variety that you guys are doing.
I think a lot of people think of industrial, massive warehouse space, and I think if people think of a lot of flex warehouse space where you have an office and then you have a warehouse component that's right next to it.
Yeah.
What a lot of people don't think about, and I didn't either until I was stumbled across this property in Huntsville, Alabama, where I had like this aha moment of a lot of people don't need an office, or they have an office, they just need another place for inventory. Mm-hmm. So when I was interviewing those customers at the location in Alabama, I was finding that a lot of these people not only were like high-end RVs and boats and like multiple cars. I mean, there's definitely personal needs, even to like hoarding, like the idea, like you have all different, I mean, seriously, like all different, or like selling, you're selling a house, you gotta move stuff. But what really got me excited, Dave, was the businesses. These are the HVAC generator, disaster recovery, electrical. These are businesses that storage is an extension of their operations. Mm-hmm. And so they don't move out very much. And then when there's that annual increase, they don't go find somewhere else because there's not somewhere else. There's not, we're not competing with mini storage that, has a lot of that competition. So I also like the expense ratio super low. So, I mean, it's concrete and steel. There's power. Mm-hmm. You have 2 LED lighting strips in each of these units. And so we price out, our facilities are about 75 cents a square foot. So $7.50 per month. And, we are, for the Bryan location, we opened up last July and we're about 60% occupied, which is amazing when it comes to like a development self-storage. Typically that's 3 to 4 year lease up. And so, I would say probably the next 6 to 8 months will be fully leased. And that's with 2 move outs a month. So I anticipate probably 2 or 3 move outs. So, I mean, so that's like I said, pretty fast.
So how many units are there altogether in that complex? Just give me an
idea. The one we have in Bryan, Texas is 72 units.
Okay.
The one we have in Huntsville, Alabama. So the new one is the one in Bryan, Texas. Okay. That's the 72 units. So that one's like pretty much, it's like 20 minutes away from where I live. Mm-hmm. The one in Huntsville, Alabama is 125 units. And we're adding on with a partner there another 70 units. So, and again, that one in Alabama has stayed 100% leased with a waiting list. We've pushed pricing dramatically. And so that's what we plan on doing with the storage here in Bryan, Texas. It's just we're working on the lease up for that facility. It's very more retail heavy driven. Like multifamily, it's easier to like third party manage. There's groups out there that manage. I would say the storage does take a little bit more of my time than like multifamily. So it's one of those things, like it's a trade-off, but
that's interesting because I've spoken to some other storage guys that just what they love about storage is that it, according to them, takes less time. But I guess it kind of depends on the kind of storage.
I guess the lease up, like once we have, my plan, like once we have our certain base of tenants, right? Mm-hmm. And we cycle out quite a few, not quite a few, but like, I've probably cycled out 10 or so tenants that have caused me headaches. They bring their friends, they'll barbecue outside, they'll do auto work inside these. I mean, these are large units, so they'll make a huge mess. But like once we get probably stabilized, I would say it's probably less work. Now, we're not boots on the ground in the Huntsville location. We have a partner there locally that, but when I say it's like a retail business, it could be freezing at night and people decide to like pour water on the gate pad because they think that will defrost the gate code pad, and all it does is just cause more
Wow.
freezing. I mean, so some of the stupid stuff that happened, but like at the end of the day, like I feel like he's had more issues than I have from an operation standpoint. But
Yeah.
of course, there are third-party management companies out there. I'm just really hands-on, and that's one thing that makes us, at CREI Partners, like we typically do 2 or 3 deals a year, and they're pretty close to where we live. I'll be in San Antonio Friday. That's a 3-hour drive, so it's not crazy. We have to get on a plane, go somewhere, and so we really try to stay close, so that way, we're running and operating the properties for our investors.
No. So where that makes sense. And where do you see things going for you and the company over the next year or two? What are you going to focus more on these storage type projects? You're going to be doing ground up, build to rent deals, or do you think multifamily is going to turn around? You're going to see a lot more opportunities there. Where do you guys see the wind
Yeah, I'm
blowing?
gonna stick to the 80/20. At 80% of it's already day one stabilized cash flowing properties with some value add component.
Mm-hmm.
I'm getting great properties that cash flow day one with fixed rate debt, non-recourse. So I'm all in on those. So those opportunities will continue to come. And then we are going to be, over the next probably 18 months, heavily focused on our development in Bryan, Texas. We'll look at other developments. I'm very entrepreneurial in my backyard. When it comes to developments, primarily it's in Bryan College Station, which is, a large city within Texas. It's central. If you think Dallas, Austin, Houston, it's right smack middle of the Texas Triangle. Large university, Texas A&M is here. A lot of growth, very friendly to developers. And so there's a lot of opportunities for myself as a developer to go out and develop in my backyard. I have
Nice.
kids. I'm not trying to like go to other cities and develop and, be away from my family. So it's important to be close nearby. But as far as like stabilized multifamily, that is all day we'll be doing that. We're always looking for our next opportunity. The storage, I don't know if for me, I want to continue. It's like build to rent, Dave.
Mm-hmm.
I did the build to rent a few years ago. That property is looking, it's incredible. It took a long time for the horizontal work to happen, the infrastructure. Once we started building vertical, which has been this year, it's going by pretty fast. But I want to see a full cycle on build to rent.
Yeah.
It's a proven system. Like people understand multifamily. Build to rent, I want to go through a full cycle on that, see who really is the end buyer of that before I get into another build to rent. Similar to self-storage or this 20 by 50, we're cash flowing very nicely. At the Huntsville, Alabama, it cash flows 9-10%. So that's really great. The 20 by 50 here in Bryan, we're working on the lease up. I want to see a full cycle of those as well. Mm-hmm. So that's why I keep that in my 20%, right? That's it's like, it's going to do well, but I don't.
That's the laboratory over there.
It's laboratory. It's cash flowing, or there's speculative, there's development, there's risk, more and more risk involved. Whereas the 80%, I mean, it's, if you're buying right, and in today's terms, like people selling right now are having to sell because they can't refinance. Their loan is expiring. And so there are losses out there. But for us who, we're more patient, we're having to, we're getting some really great opportunities. So that's what we'll keep doubling down on.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Oh, that's exciting stuff. So, Wayne, this is a very capital intensive kind of business. Do you do syndications? Do you raise capital? Do you have a fund? How do you, besides the bank loaning you some money, how do you fund your projects?
Yeah, so primarily we fund primarily, we got debt. That's typically 65 to 75% of our capital stack. The other 35 to 25% is done typically through syndications, a 506C offering. But we did one thing different on this last deal, Dave, is like we did an offering for a 506B for about a month, allowed non-accredited investors to invest.
Yeah. So just a reminder for everybody, 506B, B stands for buddy.
Yeah, absolutely. So we knew all those investors, and that was great. It was like people that weren't able to invest with us previously, but had gotten familiar with investing, becoming sophisticated, building a relationship with us. So they did that so we did that for about a month.
Mm-hmm.
And then we closed that down and then went into a 506C offering. It was the first time I had done it, worked closely with a syndication attorney to make sure we're compliant on everything. But that was really good. I mean, that we raised about $1 million through a 506B portion, closed that down, went to a 506C. But I would say primarily we partner with accredited investors, but I did like this opportunity of getting people who are not accredited in experience. So that was good. But that would be primarily what we'll do. Every deal is its own special purpose entity. And so, we do partner with those that are doing fund to funds. We do have a class for fund to fund managers to bring in. And so there is typically a class of investments for those fund to fund managers. We are the main lead general partners. And so we're always looking for other co-general partners and other fund to fund managers and obviously individual investors to partner with us.
Oh, that makes sense, Wayne. So some folks are finding it a little bit more challenging these days with everything that's shaken out with multifamily when it comes to raising capital. How are you guys finding it in today's environment?
We don't have a struggle. I mean, our biggest thing is doing what we say we're going to do, and that comes through several things. But communication, we send out monthly reports with financials. We're transparent, good, bad, and ugly. It just amazes me how many people aren't communicating to their investors.
Yeah. And
when things get tough, they're not staying transparent and they put their head under a pillow. I get so many times people, especially when I go buy a property, they're like, this most recent one, I was buying the property and I was getting that group's investors calling me, asking me what is going on. Wow. They're starting to see, anyway, it was just crazy. So communication, consistent returns. And when we do our returns, like this is nothing sexy. Like the overall return with exit should yield average annual returns 20% or more. I mean, we've seen that, but year one's typically 4%. But people love, I mean, it's 1% per quarter. It's what we project, right? IRR is typically 15% or higher once you look at the whole thing. But people want cash flow. That could be $200 every quarter, or it could be $2,500, depends on the investment. But people want to see that cash flow, and then they tell their friends and family, hey, this is
even if it's small, as long as they're seeing something.
It's just cash flows. And then the communication, I mean, they are getting depreciation. I love, Dave, that 100% depreciation is back. So that's the second. Yeah. But really the third most important thing, Dave, is our education platform. You're doing it yourselves. You're doing the podcast. We have a podcast. We also have a passive investor coaching program. It's free. It teaches investors, within like 5 hours of how to look at a deal, how to vet sponsors, how to, from their home, go in and dive deep into a property using resources that are free. Nice. So we do that heavily a lot. And then we also do a monthly virtual meetup. It's the fourth Monday of every month. We get a lot of investors that started with us there. They learn, we bring in outside speakers, we talk ourselves, and then they get comfortable and then they invest. So education's huge. The other thing too, Dave, is I think for those people who may have had investors who are no longer interested in multifamily, as an example, we're focusing on that. There's this whole new group of generation of multifamily investors waiting to be educated about
exactly. They would have never invested in it before.
Right. And so maybe those people who did invest during the peak of times, because there are ups and downs. I've been in the industry a very long time, since 2007. We've all seen ups and downs. And oh, by the way, Dave, like institutional groups suffered, during peaks and valleys of commercial real estate. MetLife, Invesco, JP Morgan, TIAA Craft, CBRE Global Investors, like these big sophisticated groups, they've had ups and downs too. So we should give ourselves a little grace, the average investor some grace too, of like, hey, there's going to be ups and downs, but for the long-term historical aspect of it, real estate is done extremely well. So I think we just got to be mindful, and we're focused on at our company. Fortunately, we have a lot of investors who continue investing and telling their friends, but we're also bringing newbies, people who are becoming accredited and looking to diversify and see the tax benefits, et cetera. We're putting ourselves out there to educate and hopefully, earn their business, Yeah,
no, that's smart. Anytime you can educate a potential client investor, it's very, very smart. Wayne, if people want to find out more, connect with you, where should they go?
Yeah, so I mentioned I would highly recommend for those interested in learning about passive investing, check out passiveinvestorcoaching.com. If you submit for the course, it's free. You'll be put into our circle where we'll reach out and find a time to do a call. But what it does is just provides a lot of resources and then get you into our ecosystem where we'll reach out, build the relationship. So definitely, check out passiveinvestorcoaching.com. And Dave, thank you again for your time, and excited to share this with my network, also to grow your podcast and visibility for yourself.
Thank you very much. It's been a lot of fun. Thanks for being on the show, Wayne.
Absolutely.
All right, everybody, take care and see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.